When people imagine a global war, they usually think about armies, missiles, and geopolitics. But one of the first places where the shock would actually appear is the financial system. Markets react faster than governments, faster than the news cycle, and often faster than the conflict itself. If a major war between global powers started, financial markets would likely respond within minutes. Not hours or days, minutes. The very first reaction would almost certainly be panic. Financial markets are built on expectations and confidence. The moment investors believe the world is becoming unstable, they start selling risk. That means stocks, tech companies, startup investments, emerging markets, and basically anything considered speculative would immediately come under pressure. Traders around the world would rush to exit positions because nobody wants to hold risky assets when the future becomes unpredictable. Imagine a scenario where a large military escalation suddenly breaks out between major economies. Global stock markets could drop extremely quickly, similar to what happened during the early days of the pandemic in 2020. In that case, the market lost around a third of its value in just a few weeks. In a global war scenario, something like that could happen even faster. Automated trading systems, hedge funds, and institutional investors would all start moving at the same time, creating massive waves of selling. Volatility would spike dramatically, and markets might trigger automatic trading halts just to slow the collapse. But while some assets crash, others usually do the opposite. During periods of global fear, money tends to move toward what investors consider safe havens. Historically, gold is one of the biggest examples. It doesn't rely on a government, a bank, or a company performing well. It's simply a physical store of value that has existed for thousands of years. During geopolitical crises, gold often surges because people want something tangible. The same thing can happen with silver, certain government bonds, and strong currencies like the US dollar. Essentially, money doesn't disappear during a crisis, it just moves somewhere else. Energy markets would probably experience one of the most dramatic reactions. War tends to disrupt supply chains, and energy is one of the most sensitive resources in the global economy. Oil, natural gas, and fuel transportation routes could become unstable very quickly. If major oil-producing regions became involved in the conflict, prices could spike sharply. Even the threat of disrupted shipping lanes could be enough to send energy prices skyrocketing. This matters because energy sits at the center of almost everything in the economy. When oil becomes expensive, transportation becomes expensive, manufacturing becomes expensive, and eventually consumer prices start rising as well. That leads directly to another effect: inflation. Wars are extremely expensive. Governments suddenly need to finance weapons, logistics, equipment, personnel, intelligence systems, and reconstruction efforts. Historically, governments have funded wars through a mix of borrowing money, increasing taxes, and expanding the money supply. When large amounts of money enter the system quickly, prices tend to rise. In extreme cases, inflation can become one of the biggest economic consequences of war. But interestingly, not every sector suffers during wartime. Some industries actually grow rapidly. Defense companies are the most obvious example. Governments suddenly increase military spending dramatically, which means companies producing aircraft, missile systems, radar technology, satellites, and defense electronics receive enormous contracts. These companies can experience huge revenue growth during periods of geopolitical tension. Energy companies can also benefit when prices rise because higher oil or gas prices increase profit margins. Another sector that would likely expand is cybersecurity. Modern wars are not fought only with tanks and aircraft anymore. Cyber warfare has become one of the most important battlegrounds. Governments, banks, infrastructure systems, and communication networks all become targets. As a result, companies that specialize in digital security, encryption, and network protection could see massive demand. Another major consequence would be the disruption of global supply chains. Over the last few decades, the global economy has become extremely interconnected. Different regions specialize in producing different components of modern technology. For example, certain countries produce most of the world's advanced semiconductors, others dominate electronics manufacturing, while others control key raw materials used in batteries and electronics. If war disrupted shipping routes or production facilities, entire industries could suddenly struggle to operate. This would create shortages. Electronics might become harder to produce. Cars might become more expensive because key components become scarce. Even basic consumer goods could experience delays or price increases. The modern economy depends on complex international logistics networks, and large-scale conflict could break many of those connections. Cryptocurrency markets could behave in a very unpredictable way during such a scenario. On one hand, cryptocurrencies sometimes crash alongside other risky assets when investors rush to sell everything for cash. On the other hand, some people see digital currencies as a way to move money outside traditional banking systems. If governments imposed capital controls or restricted bank withdrawals, cryptocurrencies might suddenly become attractive as an alternative financial network. Currency markets themselves could also become unstable. Wars often create pressure on national currencies because governments increase spending and debt. Some countries may deliberately weaken their currency to support wartime manufacturing and exports. Others might impose strict capital controls to prevent money from leaving the country. In extreme situations, governments can even freeze certain financial markets temporarily to prevent economic panic. History shows that governments sometimes intervene directly in markets during wartime. Stock exchanges have been closed in the past to prevent massive sell-offs. Price controls have been introduced to keep food and fuel affordable. Rationing systems have been implemented to manage shortages. Financial markets are normally built around free trading, but during major wars, governments often step in to stabilize the system. In the long run, wars often reshape the global economic order. The world that exists after a major conflict is rarely the same as the one that existed before it. After the Second World War, the United States emerged as the dominant economic power, and new international financial institutions were created to stabilize global markets. Large wars tend to accelerate technological development as well, because governments invest heavily in innovation during conflict. A modern global war would likely trigger massive investment in areas like artificial intelligence, autonomous systems, energy infrastructure, cybersecurity, and advanced manufacturing. Some of those technologies would eventually move into civilian industries, transforming the economy in ways that might not be obvious during the conflict itself. Financial markets are extremely sensitive to expectations about the future. They don't simply react to events that have already happened, they react to what investors believe might happen next. Even the possibility of a major war can move trillions of dollars around the world, because investors constantly try to position themselves ahead of potential risks. In a scenario where global conflict escalates dramatically, the financial system would probably go through several phases. First, there would be shock and panic. Then markets would begin redistributing capital into safer assets and strategic industries. Governments would likely intervene to stabilize key sectors, and over time, the global economy would start reorganizing around whatever the new geopolitical reality becomes. The paradox of financial markets is that even during the darkest moments of global instability, money never truly stops moving. It simply shifts direction, flowing away from uncertainty and toward whatever assets or industries people believe will survive the storm.